Give it up for Danielle DiMartino.
Danielle DiMartino.
Danielle DiMartino Booth.
Okay, everyone, welcome to the 2025 annual edition of Roundtable Prime here from the DoubleLine offices. We have our 4 returning champions plus our CEO today along with us, and we're going to cover everything about markets, macro, some ideas, and who knows where it'll take us with this diverse panel today. So thanks everyone for joining. I'm going to give a brief introduction of each of our guests, but as I said, they're all returning champions. To my left to start, this is Jim Bianco. He is the founder and president of Bianco Research. Pretty easy to remember, right? To his left is the founder and CEO of DoubleLine. That is Jeffrey Gundlach. To his left is David Rosenberg. He is the founder and president of Rosenberg Research. Do you see the themes here? Okay. And if you go to his left, Danielle DiMartino Booth, also the founder, and she's a strategist at QI Intelligence. So she wanted to diversify out the titles today. And to our left, you probably recognize him from TV a lot as well. It's Charles Payne. He's also a CEO and founder of Wall Street Strategies, and he is the host on Fox of Making Money with Charles Payne. So Danielle, you're the only one that didn't really have your name in the title of your firm, you and Jeffrey. So you're standing out today.
Unorthodox.
Yeah, unorthodox. So speaking of unorthodox, why don't we use that to pivot into what's going on in the macroeconomic environment? And I think probably one of the more prominent themes over the last couple of years, and since it seems to create a lot of divisiveness still today, is the path of inflation. So I'd like to start off with you, Jim. You've been kind of vocal about a higher structural inflation for a period of time. I won't get into your reasoning. I'll let you talk about all of that. But where do you see inflation heading this year? And let's talk both, from a CPI perspective and the Fed's favorite measure of core PCE. And do you think the Fed will achieve their target this year? If so, why? And if not, why not?
Well, let's start with CPI. I'll start with core CPI, ex food and energy. It's 53 months now. It's been above 3%. So that measure is not getting towards the Fed's target. And all the measures of inflation, the November number is the last number that we've gotten. We'll get December a couple of days after this recording, is higher on a year-over-year basis than it was in May. And that's the longest we've gone since the 2022 peak without it continuing to make a new low. So it looks like what I'm trying to describe is inflation is bottoming out at levels unacceptably high for the Fed. If you use the PCE measures, you're talking about the mid 2s to the high 2s, CPI, as I said, in the low 3s. I've been of the opinion that the inflation rate is now a 3 to 4% inflation rate. And depending on which measure you're using, that's about where we are right now, around 3%. And that this is the world we have right now in terms of inflation. Why? I mean, we can get into that with the rest of the panel as we go through, but really quickly, I would just say that I still would argue from the bigger picture, 2020 was a secular change, that the disinflation of the 40 years that we saw, the disinflation that brought about lower and lower interest rates, turned the tide with the shutdown restart of the global economy. And now coming out of it, we're in a 3% inflation world. We're not in an 8, 9, 10 or Zimbabwe inflation world. But still, if we're in a 3% inflation world and we are going to see positive real yields, meaning interest rates above the inflation rate, we're talking about a 4 or 5% interest rate world as being fairly normal, as opposed to when are rates going to come down? Maybe this is where they should be.
Yeah. Well, Jeffrey, we do a lot of work on inflation as well here. And I think back to what Jim's saying here, and I think back to kind of the aughts, right? Going before we had the GFC, you think about 2006, 2007, right? That's kind of what inflation was, right? That's where bond yields are like they are today. So how are you thinking about the world today? Has your opinion changed from this disinflation argument? How are you thinking about the inflation narrative?
From my perspective, the most important thing about the inflation narrative is the way the Fed is reacting to it. It seems that they're back to their oversteering. Looking at the most recent few months of data, which I think on the headline CPI, the month over month has gone up 5 months in a row. It's gotten bigger 5 months in a row. And I think that is the reason why Jay Powell had probably his worst press conference ever at the last press conference, because he's become hyper-focused on these short-term things again. I think that...
Well, it's because they were doing it from like a year ago when they were trying to focus on that short-term data being good.
Right. Well, that's where Supercore was born from, was this idea that, hey, we can find something. And then we got the 3 months annualized, the 6 months annualized, and he's kind of back to that again. But I think that the inflation rate on our model, which is good for 6 months, longer than that, there's too much variability on commodity prices and energy and the like. But it kind of suggests that the dream of getting down to 2% in the first half of next year doesn't look very plausible. And Powell seems to be tipping his hat to that as he talks about, the numbers. I think he said the forecast from September went off the rails, I think is what he said, which is quite a dramatic ad lib. But I think that we're bottoming out from that time period. Yet the price of WTI has become remarkably stable and centered around 70. It seems low when it's at 67, and it looks high when it's up at 74. That is not terribly supportive of massive change in inflation. So I kind of agree with Jim that we're not going to get down to the dream case of 2%. And Jay Powell seems to think so himself. And he's got himself now in that very uncomfortable position where for quite a while there, before I'd say recent several months, Powell felt that his so-called dual mandate was not in tension with itself. It was kind of like, well, inflation was coming down and the unemployment rate was still holding in at a reasonable number. But now he seemed to say in his press conference, and I think he's right to say it, that there's a developing tension between these things. He's got the unemployment rate, which is rising, not very quickly, although it is still barely above its 36-month moving average, which still puts us on a yellow light for recession. But he's also talking about the train coming off the tracks with the inflation forecast. So Powell has himself in that place where nobody wants to be, where he's got one tool, and yet the two things he's trying to accomplish with that tool are in tension with each other. As I always like to say, Jay Powell now has 1 foot on the dock and 1 foot in the canoe. And you know what happens is they drift apart. 1 foot on the dock, 1 foot in the canoe, you're going to get wet. And something is going to have to give here. And I believe that the part that's going to give isn't so much the inflation rate, because I don't think 2.5 or even 2 3/4 is that challenging for the Fed or that. But I think the unemployment rate might start going up. And what do you do if the inflation rate is 2.5, 2 3/4%, or maybe even 3%? And yet the unemployment rate is going up, and this is going to be a problem, I think. And if he's going to defend the unemployment rate from rising too much, we're going to continue to have the situation of a tremendously steepening yield curve. We've gone from negative 108 inverted from 2s to 10s to now we're up at about 40, positive 2s, 10s, and that's not even a big number by any historical standard. So it's one last thing, and that is that for the first time this year, last year, that we've had the Fed go in a pivot from first raising rates, then on hold, then pivoting to falling. This is the first time we've had yields rise on the long end in a meaningful way. If you look at all of the past Fed pivots to easing, this is the first time. This is the worst experience.
It's been meaningful too.
It's been meaningful.
Yeah.
And so I continue. Jim said, 2020, the inflation picture may have pivoted. I think almost everything pivoted in 2020. And we're starting to see that accumulate with every passing year. And I think the fundamental underneath that is 2020 is when rates really bottomed out, and they're now rising. And so many things that we think we know by mapping past cycles to the present cycle aren't working. The copper-gold ratio, which was great for a long, long time as a signpost for the 10-year Treasury yield, is completely useless since over the past few years. What's much, much better now on the 10-year signpost is something as simple as WTI. It's almost the same chart. So I really do think that we have left a disinflation environment, and I do think that we can't describe this as a secularly declining long interest rate environment anymore.
I'm thinking maybe we should ship Jay Powell some of those Thigh Masters. Remember that commercial? So we can get him to work out. So we can bring those
Suzanne Summers.
Suzanne Summers, yes. RIP. So, Mr. Rosenberg, you've been kind of on the more deflationary side of some of the forces. What is your aggregate demand models and things inferring to you today?
Well, let me just say that what hasn't been mentioned yet is that after a couple of months that were above expected, we had a November core PC print that was 0.1. And what hasn't been mentioned yet is that in the past 2 quarters, labor costs have averaged out to be 0%. I don't think you're going to squeeze inflation out of a 0% productivity adjusted wage environment so long as it persists. And I think it will. I'm not going to disagree with the fact that the year-over-year trend in inflation has leveled off, and that much is true. But the question is, why is it leveled off, and will that persist? So 40% of the price index is goods, products, the stuff you can see, touch, and feel. And they've been deflating for more than a year. The stuff you can actually measure accurately. The other 60% are services. So what's been the frustrating part of this piece of the pie are 2 things. Rents and OER and auto insurance premium. Now, the good news is that after raising insurance premiums dramatically, not just for the past year, but the past 2 years, the auto insurance companies have raised their margins to cycle highs. So the good news is that we're starting to see that in real time, is that the auto insurance numbers that were a big problem in the past couple of years have started to subside. That's very good news. The rents, we've been waiting for this. Powell's been waiting for it. It's been frustratingly slow, but it's the way the distributive lags, and we talked about this last year, the year before, in terms of how the rents are calculated in the CPI and the PC deflator. It's a bigger deal in the CPI where there's a higher weighting of shelter. But we started to see a pivot in the past couple of months where we're no longer seeing 0.4, 0.5, 0.6% increases in rent and OER in the sequential numbers. It's now down to 0.2. And what's happening is that the new deflation rents in real time are starting to overpopulate the CPI data series, and the old high lease inflation rates out of the rentals are starting to fall out. So that's going to be a major source of disinflation in the data over the course of the next year. Let's keep in mind that we have the nationwide apartment vacancy rate is hooked all the way up to 6.8%. It's at a cycle high. It's actually higher than it was in the average of 2019 before COVID, when it averaged 6.2%. And we have an unprecedented pipeline of construction supply coming on board into the rental market for 2025. So I'm very comfortable with the view that the surprise will be, and let 35% of the index is rental and OER. That's going to be a major drag on the headline numbers. I don't expect, especially with China exporting its deflation to the rest of the world, there's no inflation coming out of the commodity markets, and the dollar is up 5% in the past 3 months. There is certainly no inflation. In fact, you mentioned deflation. The deflation in the product sector is going to persist. And I think we will get a rental and auto insurance-led disinflation in the services sector. So look, when we model this out, and this will be the big surprise to the Fed, and the Fed is a specialist in pivoting every 3 months, but they'll pivot back because by March, we expect that the core PC inflation rate, which is what they target, is going to be down to 1.9%. And they raised their forecast. It's a layup. They raised their forecast in the last set of projections to 2.5% by the end of the year. So I guess I have a different view. I really do not believe that COVID has changed the underlying dynamics of inflation. Yes, we're going to get supply shocks along the way. We just had a major supply shock in Los Angeles. However, and this is what happened in the FOMC minutes yesterday, it's all about Trump. It's all about Trump. And I'm not forecasting around Trump because I don't know what he's going to do or what he's not going to do, but the Fed has said, what's it called? Their placeholder, their policy placeholder. They're now factoring what Trump is going to do when nobody even knows what he's going to do. He hasn't even taken office yet. What will the tariffs look like? Will there be tariffs? Will there be select tariffs or not select tariffs? Immigration policy, like we don't know. We don't know. We're in a bog of uncertainty, and I understand that. And Trump himself is very unpredictable. But I'm not going to provide forecasts based on what Trump is going to do or not do. And I don't know what he's going to do in fiscal policy with a one-seat majority in the House of Representatives. I don't think he's going to get as much done as people think on the fiscal side. But what I will say, and this is what's interesting in the set of FOMC minutes, and something that hasn't been mentioned so far, is what's happening with ChatGPT and generative AI, and the fact that this is internet light, and that this is a productivity game changer. I don't think anybody really knows, and I guess the stock market has laid down its bets, because there's no way the stock market could be right on AI, and we don't get a significant shift in the productivity curve out of it. And productivity has a huge, statistically significant inverse correlation with inflation. Productivity is an inflation killer, which is why we had vibrant growth in the U.S. in the second half of the 1990s, but inflation came down. And by the way, Alan Greenspan nailed that call. So how can we talk about inflation? And we just had, Jeff, and we had Jim, and not talk about the productivity outlook. How do we do that? And so, no, I think that we don't know what the total size of the AI market is going to be. We don't really know just yet how important it's going to be, except we know that it's going to be damn important. And it means that we're going to go through a structural shift in productivity. And that is going to contain labor costs. You don't get labor costs, you ain't getting any fundamental uptrend in inflation. In fact, I believe that the surprise will be this year and next year going forward, that inflation is going to be coming down more significantly than what's priced in right now.
So Rosie brings up a great point on the incoming administration. How does that impact your guys' view, Danielle, Charles? Like when you guys think through this too, just what do you see being some of those impact? Because as David said, I mean, it's very difficult to know what's bluster, what's not. Is there land grabs? Are we having deportation? I mean, all these things will change the growth and inflation environment.
Without a doubt, Jeffrey. And what I try to look to is the 2018-2019 episode that landed the world with contracting world trade for the full year of 2019. Of course, that episode was rescued, if you will, by $15 trillion in fiscal spending for the pandemic. But when you look at the 2018-2019 episode, what you see was the lag effect that did manifest in goods inflation took a good 12 months before it even really started to show up. And that's why I think you have to take into context, this is a John Thune-run Senate. So he's very much a traditionalist, a politician. And the one-seat majority in the House of Representatives, I think best case scenario right now, House Speaker Mike Johnson is saying that he hopes to have the extension of the tax cuts completed by somewhere around Memorial Day, so May. But there's going to be a tremendous amount of political capital expended initially just to extend those tax cuts, and that's not going to be...
You're not talking about incremental, you're just talking about
not
just
incremental,
extending the existing.
Just preventing the sunsetting at the end of 2025 of the 2017 tax cuts is going to require a lot of political capital in the Senate and in the House of Representatives. And in the meantime, I think what people have... I understand that it was arguably Powell's worst press conference. I'm not necessarily going to disagree with that, but as a former Fed insider, I took the time to read Powell's transcript. And there has been a distinct narrative shift that we've actually had backed by, I call him his chief lieutenant, Christopher Waller, just in the last few days. And that is supercore inflation's out the window. What Powell's focused on right now is market-based core PCE. And it's something that's been around for a very long time. It's not something he made up out of thin air.
Well, because supercore is not accretive to the narrative. Fair enough?
Fair enough.
Yeah.
And but if you look at where that metric is, and then you incorporate what he specifically said in the press conference, and that is new rents are the market. And he's referring to some great work that's come out of, ironically, since Beth Hammack dissented, the Cleveland Fed. And if you look at the new rent index, it only comes out on a quarterly basis. It suggests that the shelter input, so shelter is 46% of core PCE, that the shelter input alone by the end of 2025 is going to drift from around 5% year over year to around 2% year over year. You can't do that math without there being a gravitational pull on inflation. And the reason I bring up the Cleveland Fed new rent index is because we've had 500,000 units come online for the last 2 years. We've got 800,000 more apartment units in the pipeline that are coming out this year and into 2026. You have spec homes that are on the market and completed at the highest level since 2009. So there's a lot of supply that's now coming online, whether it's new homes or apartments, that's going to act as a pull on this source of inflation. And that's where you get the word imputation. Now, I don't want to get too far into the weeds here, but the reason that Powell was so specific in saying shelter is new leases is he's effectively taking out the one area of market-based core PCE that is imputed, because it still contains OER, even though OER is anything but market-based. So if you substitute that out, you're actually underneath the 2% target right now, today, already underneath it. Christopher Waller followed him a few days ago by reiterating the market base and the lack of efficacy in relying on imputed shelter inflation. So I think we have to pay attention to that. We cannot fade the bankruptcy cycle and the effect that that's going to have. We cannot fade what Dave was just talking about. There was a new article out today that said 200,000 back office jobs on Wall Street are going to be replaced by AI in the next 3 to 5 years. It's a real phenomena. And you also can't fade the fact that services spending is finally now getting hit. In the latest University of Michigan, you had Conference Board, you had intentions to take vacation 6 months out fall to a 4-year low. So whatever's happened with the median duration of unemployment kicking up to 10.5 weeks, with not seasonally adjusted continuing claims being 5,000 off their post-cycle high, 2.175 million as of the latest print, stubbornly high, staying stubbornly high at multi-year highs. You're finally starting to see that play out in wage disinflation and in services spending getting hit. So yes, we may have tariffs. Yes, there may be placeholders. But if the script plays out similarly to what it did in 2018 and 2019, we still won't see it manifest in goods inflation for at least 12 months. And there's going to be a major offset on the services side in the meantime.
I want to come back to the services idea, but Charles, I'll let you have the question since Danielle gave us great analysis, but didn't answer the exact question. But it was a great answer. What do you think about the political side of all this? Or is it too dangerous? No one wants to touch it?
No, I don't think it's too dangerous. I think Trump is in an amazing position to get things done. And I think one of the good things is that everyone keeps underestimating him. They underestimated that he would win the majority, the majority of the pollsters and the experts. And this time around, unlike the first time around, the first time around he was going to drain the swamp. Unfortunately, he brought a bunch of swamp creatures into his administration. You can't drain the swamp with swamp creatures. This time around, he's got people who are extraordinarily powerful, perhaps the guy with the biggest microphone in the whole world. So it doesn't matter if the New York Times is going to back you, if Elon Musk is not, right? And he's got a Western world that knows they're in trouble. And that bureaucrats around the world are trying to stop the citizens of those countries from having a voice. You go and you vote. Hungary, they take away your vote. You go in Italy, you vote, they try to muck up the works. France, they muck up the works. So it's only emboldening the citizens of these countries that know something has gone wrong in the last few years. Why are we not having babies anymore? Why are we not creating anything anymore? And in this country, one of the most frustrating things for me is this aggregated data representing people. Like when they say the consumer is strong, what are you talking about? Who is the consumer when the top 20% of the country is doing 40% of the purchases? And then the Fed is in this so awkward position with this dual mandate in their policy prescription, because if the richest folks out there are getting these dividend checks and have all this money in money markets and they're getting hundreds of billions of dollars and they spend it, yeah, the data looks amazing. The consumer looks strong. Everyone else is seeing their credit card rate go from 16% to 23%. Delinquencies are going through the roof, particularly for young people. And it's against that backdrop that President-elect Trump has a mandate. And I think he's got this media part of it. Is a big part of it. if you look at polls, YouGov poll, they did a poll of young folks recently. The change since November to now in terms of approval rating amongst people who didn't vote for Trump through the roof. So he's got this kind of, momentum going for him. And I spoke with Thune about a month ago. He's a brilliant guy, right? But this is Trump's party. This is President Trump's party. All of the non-Trumpers are gone, or they're spying the exit. So, and they also understand mistakes, right? When Obama came in, he had a similar platform, and he had all these grand things he was going to do, and all of a sudden Kennedy dies, and Scott Brown gets in a pickup truck and goes across goes to every city in Massachusetts and pulls one of the ultimate political upsets, and Obama gets nothing done except the Affordable Care Act. But all the other things died because of all the political horse trading within his own party. Now, we saw some of that with the speaker thing, right? But we also saw Trump get on the phone. I had a Representative Norman on, the last week on the show. I was the first person to bring Norman on before he ran for office. Someone said, "Hey, Norman's running. He's a good guy." I said, "All right, I'll bring him on." You've got your own tribes within the party, but I think listen, they understand that the opportunity is now. That there's no chance if they blow it. When will they ever get this opportunity again? And they know that it's not 4 years, but it's just maybe a year and a half, right? Certainly by midterms, you better show something to the public. Now, and I also think that the public knows that it might not be, it could be painful initially. How did they know that? Because every night the news came on, they said, tariffs are going to be painful. People heard that. If there's anyone that's ever turned on the TV or read a newspaper or listened to a podcast, first thing they heard, Trump's tariffs are going to be painful. And by the way, he never pushed back on it. He never said it wouldn't be painful.
Jay Powell said there would be pain too, don't forget. Yeah,
yeah, right. And the markets responded to that, right? So, but I really hope that in addition to all of this, somehow we reel in the Federal Reserve. I really think that's the wild card here. And I think it's the dual mandate, and it's just, what really roils me is the sort of that thing he says at the end, right before he takes the questions. We know our policies are affect all Americans. Then why do they always hurt the bottom 75% no matter what the hell you do? You have to figure something out. You always tell me, the Fed is always telling us, the only tool we have is a mallet. Well, you better figure out the way to get a scalpel and something else, because or your goals are too ambitious. Your power is too much power if you can't wield it in a way that it doesn't continuously hurt the majority of the population. And that population is backing President-elect Trump. So for right now, I think he's going to accomplish more than people think he will.
Jeffrey, can I add one political note?
Of course, please.
So I think the elephant in the room that people are not fully appreciating is, let's say you get just deportations of people who are in prisons. Somebody actually put pen to paper a few days ago and showed what the effect would be on food stamp spending. I kid you not. And let's say Vivek and Elon are, and I visited with Vivek when he was campaigning, and we blueprinted how to redo the Fed. But let's say that they're remotely successful. That's disinflationary. 56% of all the jobs that have been created have been in government jobs the last 12 months. You start cutting heads in that arena, it's all disinflationary. I don't know. I'm not convinced that Trump will necessarily be on board with the repercussions of what the Department of Government Efficiency is aiming to do, of what mass deportations would do to consumer spending when consumption 70.1% a record of GDP. Because most of what's being discussed, with tariffs notwithstanding, which again, there's a 12-month lag, is disinflationary.
What about all those people? What are they going to do? Right? I mean, there's like 15.5 million, 16 million folks that work in the government. What are they going to do?
Well, what are they going to do with AI? Because I think Rosie brought up the critical thing. Think about last year, Salesforce.com. Beginning of the year, the stock was down 14% into April, right? Because, AI, hardware, they're getting all the action, software, and even Benioff's job was, even people were saying maybe he shouldn't be, give up the job. They come up with these AI agents. The stock is up like 60% now. It's a juggernaut. According to McKinsey, AI agents are going to replace 800 million jobs around the world. I mean, these are mind-boggling numbers. And just like ChatGPT, they announced it November 30th, 2022. It was an innocuous announcement. just look like nothing, change the world like that, because it happened, but it happened maybe 5 years faster. The ability, the speed, the power, and the power that it puts in the hands of a regular average person. I mean, I interviewed Sam Altman like a month ago. What's on the drawing board and how quickly this is happening. Unit labor costs, yeah, it's going to, the productivity miracle Greenspan always bragged about, it's going to be the same thing, although in a different kind of way. And that's a great question. No one really knows. You could read where maybe 10 years from now, 15 years from now, 60% of the jobs that will be out there don't exist at this very moment. But that gulf between here and there, what do human beings do? I mean, that's what the Andrew Wang ran on. Right, he said he wanted a universal income, basic income, not because of anything else, except that there will not be jobs. He's in the tech sector.
But he also ran on math. Math is not popular in the country, okay? And don't forget that. Don't forget that. Yeah, yeah.
Can I jump in on Bob Gordon, who's a professor at Northwestern University, has written a lot about tech innovation, and he's talked about that tech innovation historically has always been a net creator of jobs. So the problem with innovation is we can see the jobs that are going to be replaced. It's, as you point out, 60% of the jobs that we will have in 30 years don't exist now. It might even be higher than that. And we don't know what those jobs are.
Right.
And, just like the example that he uses, you hold up your phone in 2007, here's Steve Jobs with the iPhone 1. Raise your hand if you said that's the end of the hotel business. That's going to forever change the taxi business. You didn't foresee Airbnb and Uber, but those are the types of things that technology unleashes. So, yeah, what's going to happen with the economy is we're going to see a fundamental change in the economy. I liked, Brian Moynihan at the Bank of America. He talks about that they're spending more money on technology and AI than any other bank. But I always wonder, because he seems to think that Bank of America's business model is going to stay exactly the same way it is. We're just going to import some computers and we're going to replace some middle management people, make it more efficient. We're going to change the entire business model of how this stuff works. Probably starting with Moynihan's job, but maybe that's the uncomfortable part. So what this technology is going to do is it's going to forever change what we did. The last thing I would give you is the internet itself. When it first came in, one of the first casualties of it was the newspaper business. We created, the internet and blogs and now Substack, and then we went after broadcast and we've got YouTube and everything else. But look at the influence and the power and the jobs that they've created. So this technology is going to be a net plus. But I agree with you, getting from here to where we're going to be is going to be a bumpy road.
But you could say that from, what's the post-World War I era, right? Where we went from farming and agriculture to industrial. It got accelerated post-World War II. But I mean, no one envisioned that. Then we became a service economy. So it's that gradual change I don't think we see. Mm-hmm. And you read these forecasts and people think they're so grandiose. But as you point out, there is an evolution, and, people didn't think there would be the jobs that exist today. So with that, as you kind of look at the dynamics, where does this put us in the economy for now? Is there going to be pain as, from the tariffs and the deportation side? Do we have to suffer through that to get there? Or can we continue to kind of glide through as we have so far? I mean, I'll throw it out to any of you. It's a small question.
Yeah, no, I think there will be pain.
Yeah.
I think it's, remember Reagan, right? Reagan took a lot of heat. The first couple of years, a lot of heat. Between Reagan was trying to achieve and Volcker, it was tough stuff. I mean, even Arthur Burns, he gets a bad rap, but if you read, one of his biographies, he talks about the fact that the political pressure that he got, and that made him blink, so to speak, and so, but Volcker, he just
feel like that's the way we're going now with, Trump talking about Powell?
There could be some pain. I mean, there could be some pain, and again.
Charles, will Trump take the pain, though?
Yeah, of course.
I'm asking you a very viable question. He still judges his success based on where the S&P 500 is trading. Is he mature enough to take this pain?
He's happy to take pain in the bond market, and he's just not happy to take pain.
First and foremost, I hope he switches from the Dow to the S&P 500. It's like, oh, man.
The numbers are bigger.
Yeah, right. It's like... I think he'll take the pain. Listen, I spoke to him briefly earlier this year in Mar-a-Lago. It seemed like it's so interesting. I think about Meta stock, Facebook, when everyone wrote it off. And then after that, we had what I call the maturation of Mark Zuckerberg, and the stock has been up like 20,000% since then. Trump looked a little different, and he had the same energy. He had been to 2 states that day. But if he felt like, listen, the first time I don't think he even really thought he was going to win, to be quite frank with you. He was caught flat-footed. And but this time, I think they've got more of a game plan, but it does involve a fair amount of pain. And the thing is, for him, everyone warned that there would be pain. Everyone says Trump's policies. There wasn't an article in October, November that didn't say there's going to be pain. If you elect Trump, there's going to be pain. We can't deport criminals. There's going to be pain. And so, it won't be a news flash for a lot of people. It's incumbent upon him to make sure he holds their hands properly and say, listen, this is what the kind of pain it takes for reshoring. But remember, last time I was in office, there was no such thing as reshoring. And every subsequent year after I triggered it, we brought more and more businesses back to America.
Can I throw a question at you, and maybe anybody else wants to answer it? In Trump season 1, we had the line that you need to take him seriously, but not literally. And now we've got Trump talking about Greenland and Canada and Panama and, all this other stuff. Should we remember that line that we should be taking him seriously? When he talks about Greenland, he's really talking about a security threat that he wants to get rid of more so than, having it with a running gun battle with Canada to be the 51st.
I would say on a scale of 1 to 10, Panama is a 10. He wants Panama. He wants the Panama Canal, rather.
I understand that because there's an asset there that, quite frankly, is not being managed very well, and it does impact us. And it used to be our asset to begin with, and that needs to be fixed. But does he want the Panama Canal fixed? Does he want Greenland security to be solved? Or does he want those? In other words, do we take him
if he could buy Greenland, he tried to buy Greenland for $100 million, right? At one point, and they rejected the offer like 60 years ago. But
maybe that's where Doge comes in, Dogecoin, right? He can use that to buy it.
Yeah, we'll mess it up for you.
The beauty of Trump is that he speaks, and this is what you're saying, and I guess I'm sort of agreeing with where you're going with that. He speaks in metaphors, and that's actually why he connects with people. The career politicians, they think that the way you connect with people is you give them all this down in the weeds, you have tremendous command of specificity and all this stuff, and then they mock Trump because he exaggerates everything. The figures he gives tend to be loose, but they're not seeing what's really going on. He's speaking in a way where people like the direction of the metaphor, and I agree that Panama's probably a 10. Greenland, I think is we've been here before.
Yeah,
I mean this immense tariffs on Denmark. I don't think that's going to happen. I don't think it would have any effect.
What is it? Pickled herring that we?
Yeah, right. What are you really talking about here? But and that's the same thing with the Gulf of America.
Yeah.
Right. I mean, how do these things get named? By the way, who's it up to?
I mean, technically, it's all America. It's North and South America. It is a Gulf inside of America.
Yeah, but how do these things get named? We've changed the names of forts, but that's the Defense Department. We know who does it. But the Gulf of America, it's the same thing. He's pushing this theme of caring about Americans. This goes back to what Charles is saying. People feel like they've been abandoned because they have been. And I'm very focused on this fire because I right in the path, and the fire came to my property last night, and people can't understand that the fire hydrants don't work. The fire hydrant. We have an ocean. Why don't we set up a system that has an unlimited water supply, right? Just pump it out of the ocean. Use salt water, but we don't do that. We have these policies that get put in place, and it's always short-termism. It's always yield to next election, yield to power, and they don't realize that in thinking in that short term of a time frame, that they're putting in policies that are short-termism, but are putting mismatches between the systems that were in place under a certain population and a certain, in the case of Los Angeles, a certain physical build-out, and yet in the short-termism, they keep expanding the development, and the infrastructure doesn't get changed. And all of a sudden, people wake up and say, hey, My house just burned down, and so did another 20,000 of them. And it's rich people that thought they were protected, thought that by being cozy with these development-oriented politicians, that somehow they would be immune from the consequences of their own ideology. And one by one, this is way big. One by one, people are waking up to the fact that they've been completely abandoned, and there's nothing in it for them. In the trajectory of the policies are actually fatal. And the way that that's being seen now increasingly, and I've written an article in the Economist recently on this, is in the deficit. I know I always talk about it, but obviously you have to be asleep to not realize that people are aware of this. That's kind of the impetus, I'd say, for DOGE, which is a little bit, again, it's a big metaphor. It's kind of gimmicky. We're going to find $2 trillion. Yeah, good luck. I mean, we can all agree that we don't want $6 million to promote Egyptian tourism, which we actually paid for. We don't need, but those things don't add up to much. So at the same time as we're at least acknowledging that there's this problem, at the same time we're talking about tremendous spending, extending the tax cuts. I don't think that's a very good idea, but in general, I think this trajectory that we've been on that hasn't been a problem heretofore, and I'm talking about the deficit now, it's going to be a problem. This is what the article I wrote about, just like our mismanagement of our water system in California, which has been horrifically bad. I mean, Gavin Newsom should resign because he manipulated the water system to put us in this position that we're in Los Angeles County. But all these things are sort of coming apart at the seams, and I think it has a lot to do with the stubbornness of the older baby boomer politicians. They just won't go away. And they believe in this system. They believe that since they've lived their lives and they've never suffered the consequences, ultimately of where this trajectory is headed, that there are no consequences. And one by one, people are waking up saying, no, I'm not protected by Louis the King. I'm not protected. I'm going to be vulnerable when they are exposed to be not in the best interest. And we're on the cusp of that happening, and it explains Trump. But Trump talks in these metaphors of, hey, we want to have something for not just the top tip of the iceberg. And this is an inexorable trend, in my opinion. And it'll ultimately lead to some success, but it will involve pain. I agree with that.
Speaking of Payne, Charles, you wanted to say one more thing. I'm going to give you the last comment on this because I want to stop after this and I want to take a break and I want to bring it all back to markets and start talking about the impact on financial markets. But give you the last thought. I tried to be.
The name you didn't bring up was Scott Bessent, right?
That was good.
I think Scott Bessent is a wild card here because you brought up deficits and he's talking about getting them down to 3% by, I think, 2027. Again, is the pain,
Isn't that
right?
the interest payment? Isn't it 3% of the GDP? Isn't that where we are today?
Yeah.
I know it's tongue in cheek, but
it's nuts.
Yeah.
I mean,
it service the debt. Yeah.
I listen. I think he's one of perhaps the best pick of the Trump of the cabinet. I think he really. I mean, if you want to have confidence in someone, and this again is not someone who's outside. I think
the markets definitely liked him.
I think he's going to be a really, really key player, like the MVP of the team, if they pull this off. But again, it's going to involve some pain.
Well, I want to stop there. This is going to be the end of part one of the roundtable. I'm going to take a small break for those that are in the audience today. We'll come back and we'll show you part two very shortly, where we discuss the implications for markets and some of the outlooks for various parts of financial markets around the world.